But Mark, it's great to have you on today.
It's my pleasure. Thank you for having me.
We're parsing through this jobs report, and I think the question the market is trying to answer is whether this stronger than expected jobs growth in the month of July will embolden the Fed to raise rates at a faster pace than expected. Your thoughts there?
Look, I think they do. But I think what we're missing, we keep talking about the Fed raising rates. We know they are. So to me, whether they raise them by 50 bips, 75 bips, that's not what I'm focused on. What I'm focused on is when do they start lowering rates again? And sort of, you're going to have that happen sometime next year. And the question is it in the middle of next year? Is it at the end of next year? But it's definitely by the end of next year. So I think you're going to have this raising of rates for a little while. You're going to have pain. And the focus is really going to be on sort of making sure you've tamed inflation. But then the focus is we don't want to be in a recession. We don't want to stay in a recession. So inflation is what we're focused on today. But then the next focus is going to be getting out of a recession.
Yes, stocks are down today, although we've seen a vicious rally in the S&P 500 mark, up about 13% from the low hit in June. Yep. I'm curious if what we're seeing today is sort of a reset and following what the bond market has been pricing in, which is more of an economic slowdown?
I think there is going to be an economic slowdown. It's impossible for there not to be. You can't have rates moving up and not have that slowdown. So, the question is just how long does it take? I mean, people's interest rates are going up on their mortgages. People are going to have less money to spend. So, consumer spending is 2/3 of GDP. So you're just going to have less money as rates move up. So the market knows that. So the market's focused on where are we a year from now? And then I think what this jobs growth number has done is sort of push everything back probably another 3 months before the Fed starts lowering rates.
At this point, though, rates are rising. The cost of capital is rising. Let's talk about corporate credit, your wheelhouse. Is this creating more distressed opportunities? Going into this year, many corporations were not expecting a 300 basis point hike in rates.
I lost you for a minute. Oh, there you go. You're
Corporate
back.
credit. Yeah, just was going to ask you about what's happening in the credit market now as the cost of capital continues to rise. Is that creating distressed opportunities for you, Mark?
It is actually. It's creating a lot of opportunities. It's much more on the specialty lending side. And the reason for that is just people need capital, right? So when people need capital, we're able to lend it. I would say for us right now, especially on our specialty lending business, before we were lending around 8 to 10, now we're lending between 10 and 12. So we're just finding more and more opportunities, especially in Europe, because there's a lot of issues. There's a lack of capital there, and in Asia. So I think for us, the more rates move up, the better it is for our business.
Shepard Smith here. Thanks for watching CNBC on YouTube.